While the principles of cash versus accrual accounting might seem complex, let's simplify. We'll start by defining the core concepts clearly.
Welcome to this explainer. Look, if you're gearing up for the CFA Level 1, or honestly just trying to wrap your head around financial statement analysis, you are exactly where you need to be. Today, we're tackling one of the most crucial, frequently tested, and frankly foundational topics you'll ever face: cash versus accrual accounting. Whether you're prepping for an exam or you just want to understand how real businesses actually report their numbers, we're going to crack this code together. Let's dive right in. Okay, let's take a quick look at our roadmap. We're going to hit the basics of cash versus accrual, look at the golden formula, walk through an Infosys case study, do a quick-fire CFA quiz, check out AI and analysis, and then wrap it all up with some pro tips. Starting right off with Section 1, the basics of cash versus accrual accounting. So when you strip away all that heavy accounting jargon, the fundamental difference between these two systems really just boils down to one simple concept: timing. Think of cash accounting kind of like your personal checking account, right? A transaction is only recorded when physical cash actually changes hands. But accrual accounting, that records transactions the second revenue is earned or an expense is incurred, totally regardless of where the cash is. And the golden rule you need to take away here is that accrual accounting reflects the true economic reality of a business, not just the mechanical movement of cash. Now, you might be wondering, why even bother with the more complicated accrual method? Well, global financial reporting standards like GAAP and IFRS actually mandate it. But why? First off, it's the matching principle. Accrual accounting forces a company to match the revenue it generates with the exact expenses it took to generate that revenue in the exact same time period. This totally eliminates those weird cash timing distortions. So because of this matching, it shows the true profitability of a company over a specific period, which gives analysts and investors a vastly better way to measure management's actual performance. Moving on to Section 2, the golden formula. We're linking accruals to earnings quality. All right, now that we know why accruals exist, we absolutely have to uncover how they mathematically impact a company's earnings. And here it is: net income equals cash flow plus accruals. I'm telling you, locking this into your memory is a massive hack for the exam. It basically says that a company's bottom line profit, its net income, is made up of two distinct parts: the hard cash it actually generated and the accounting adjustments, or accruals, made by management. So how do we actually interpret this formula as analysts? Well, step one, if a company has really high accruals making up its net income, that immediately leads to lower earnings quality. Why is that? Because accruals involved a lot of management estimates and judgment calls. And honestly, that introduces analytical risk. It means those profits aren't backed by cold, hard cash just yet. On the flip side, step two, low accruals, mean the net income is tracking really closely to the actual cash flow. That leads to higher earnings quality. You can just trust those earnings a whole lot more. To make this super concrete, what exactly are these accruals? The most exam-relevant sources usually pop up when the timing of cash and the timing of a service simply don't align. You've got accounts receivable, so you earned the revenue but you haven't been paid yet. Accounts payable, you owe money for an expense but haven't actually paid it. Prepaid expenses, you paid cash upfront for a future benefit. And unearned revenue. You got the cash in hand, but you haven't done the work yet. These are the specific adjustments that bridge the gap between cash and net income. All right, Section 3. Let's look at a real-time scenario with an Infosys case study. It's one thing to just memorize a formula, right? But let's apply it to a global IT giant like Infosys to see this timing difference out in the wild. Imagine Infosys delivers a massive project to a client in March. But per the contract, the client pays the invoice in April. Under the accrual method, Infosys records that revenue in March because that is when it was economically earned. But under the cash method, absolutely nothing shows up until that check actually clears in April. It's the exact same work, the exact same money, but it hits the financial statements in totally different months. And this leads us directly to a really crucial risk insight. Remember, under accrual accounting, Infosys recorded revenue in March and created an accounts receivable. But what if April comes and the client just doesn't pay? And then May rolls around and they still don't pay. If you see a company's receivables going up significantly, meaning their accrual revenue is rising, but the cash flow is not following, that is a massive red flag. That's the kind of aggressive revenue recognition that doesn't just lower earnings quality, it's the kind of stuff that literally gets executives featured in true crime documentaries. Okay, Section 4, time for a CFA quick-fire quiz to test your knowledge. Let's wake up those brain cells with a little active recall. Here is your first practice question. A company reports a net income of 500 rupees. Their operating cash flow is 350 rupees. Based on that golden formula we just explored, calculate the accruals. I'll give you just a second to run the math in your head. Got it? Let's check. The accruals are 150 rupees. Remember the equation? Net income equals cash flow plus accruals. So if we just rearrange that, accruals equal net income minus cash flow. 500 minus 350 gives us 150. And hey, always tie the math back to the core concept. If those 150 rupees in accruals represent a huge chunk of the 500 in net income, you might be looking at lower earnings quality. All right, let's try a concept-based question now. Which of the following situations indicates the lowest earnings quality? Option A, net income is 1,000, cash flow is 950. Option B, net income is 1,000, cash flow is 300. Or option C, net income is 1,000, cash flow is 1,050. Try to spot the outlier here. The correct answer is B. But why? Well, in option B, there is a massive 700-point gap between the reported net income and the actual cash flow. That huge gap means higher accruals were heavily used to puff up the net income number. And as we've established, higher accruals directly equal lower earnings quality. Simple as that. One final quick-fire question for you. A company receives a 20,000 rupee advance payment today for services they will deliver next month. What is the correct accounting treatment for this cash under the accrual method? The answer is unearned revenue, which actually sits as a liability on the balance sheet. I know, even though the cash is safely in the bank, the company has not earned that revenue yet because they haven't delivered the service. So it absolutely cannot hit the income statement. It's a liability because the company now legally owes that service to the client. Moving on to Section 5, AI in Financial Analysis. We're talking modern tools for analysts. Look, understanding the manual math is completely vital for the exam, but how is this actually done in the industry today? Back in the day, manual analysis meant analysts poring over spreadsheets just to calculate these accrual gaps across multiple years. But today, we have AI agents like Microsoft Copilot. These tools can instantly compare net income versus cash flow across decades of data. They automatically detect high accruals and flag rising risks in absolute seconds. And this is exactly the kind of insight a modern analyst is looking for. Imagine prompting your AI tool and it just spits out, revenue increased 20%, but cash flow declined, possible aggressive revenue recognition. That is the exact red flag scenario we discussed earlier with emphasis, but served up instantly by AI. It doesn't replace you as the analyst, it just makes you incredibly efficient at spotting exactly where accrual accounting might be hiding a really bad economic reality. Finally, Section 6. Let's wrap up with some pro tips and hacks for CFA Level 1 success. We've covered a ton of fantastic ground today, so let's lock in these high-yield hacks for your exam. Tip 1, always compare net income to operating cash flow. Tip 2, memorize that golden relationship. Net income equals cash flow plus accruals. Tip 3, when you're analyzing, focus heavily on the core adjustments, your receivables, payables, and prepaids. Tip 4, the CFA tests logic, so always link the level of accruals directly to earnings quality. And finally, tip 5, don't overcomplicate this. At the end of the day, it is simply a difference in timing. I want to leave you with this really powerful thought. Cash tells you what happened, but accrual tells you what actually belongs to that period. Mastering that difference is what unlocks real financial analysis. But here's a question for you to chew on. If AI tools like Copilot can calculate these complex accrual red flags in mere seconds, will tomorrow's CFA analyst just be a number cruncher? Or will they need to be more of a high-level business detective? Keep that in mind as you study, and we will catch you on the next explainer.